All right, hello y'all. This is Carter, and this is going to be the first of the four sophomore technical review sessions. This one is going to be over accounting. So I'm basically just going to be going really quickly through what is accounting, the three financial statements, and through some of the potential interview questions that you might have to deal with. Just kind of questions like, walk me through the three statements if this happens, or maybe how do the three statements link? But I'm going to be going pretty quickly on this, so I would definitely recommend maybe watching one to two times or maybe rewinding. I'm just going to try to make this as quick as possible because it was designed to be a 2 hour lecture, but I'm probably going to try to condense this one into about an hour, but we'll see. But I'll get right into it. So, first of all, just what is accounting? So, accounting is the language of business, and it is what allows us to quantify how a business is performing. So, it's really important when you're thinking about stocks or just businesses as a whole, and basically any field in high finance, you really have to understand how accounting works. Because if you're trying to value a business, or if you're trying to understand why one business is better than another, you have to understand how that works quantitatively. It's not just all qualitative stuff. You have to see, okay, what does this business do? They provide some good or service and then hopefully generate a profit. But let's see what that actually looks like with the numbers. So that's really what accounting is. It's the language of business. And at its core, when we want to value businesses, it's all about the cash flows that a business will generate and the riskiness of those cash flows, which you'll see next week when I do the valuation lecture. And accounting is really what allows us to figure this out. By using accounting, the language of business, we can figure out the actual cash flows that a business will produce. And then by looking at the business and understanding how it works, especially qualitatively, we can try to quantify the riskiness of the business, which then allows us to value the company. So after the 1929 the stock market crash in 1929 and then the subsequent Great Depression, the United States decided to regulate publicly traded companies a lot more. They created the Securities Exchange Commission, the SEC, and now all publicly traded companies are required to release their audited financial statements 4 times a year, once a quarter, and they all have to follow the same accounting standards. So in the U.S., it's GAAP, which is generally accepted accounting principles, and then for international companies, they follow IFRS. And there's a few differences between the two, but for the most part, they're pretty much the same. And the three financial statements that publicly traded companies are required to release are the income statement, the statement of cash flows, or the cash flow statement, and the balance sheet. So let's get into what each of these three financial statements mean. So the income statement is what's showing a company's revenue and all of the costs that they have during a certain period of time. So it could be a period of 3 months, it could be a period of a year, 3 years, but it's basically showing all of the money that a business is bringing in through its core operations, and then all of the costs that the business incurred during that period. So, for instance, with a lemonade stand, it would be all of the money I'm making from my core business offering, which would be selling the lemonade, and then all the costs associated with my business, which could be direct costs, like the actual how much the lemonade itself is costing me to buy, or the labor that I'm having to pay, or the labor that I have to have paying my employees, right? And then also like taxes, paying interest on the debt I have. All of these are expenses that would show up on the income statement. And revenue minus all of these costs equals our net income. And this is, again, over a certain period of time. Cash flow statement is also over a certain period of time. And this is basically showing all the ways that cash is flowing in and out of business. So it's really what allows us to see, okay, during a period of time, maybe a year, did the business gain cash or did it lose cash, right? And there's three sections of the cash flow statement: the operations segment, the investing segment or section, and then the financing section. So these are the three sections, and I'll get into those in a little bit. And then lastly, we have the balance sheet, which is really showing a business's assets, liabilities, and shareholders' equity at a specific point in time. The balance sheet equation is assets equals liabilities plus shareholders' equity. Sorry, this should be an equal sign. And I'll talk about this in a little bit, but basically you can think of this equation as a company has assets, right? There's tangible assets and intangible assets that a company has, right? They might have cash, that's an asset. They might have factories, that's an asset. A lot of different things can qualify as an asset, both tangible and intangible. And of course, there's the claims on those assets. First, you have the liabilities, right? Those are the people that you owe things to, right? You might owe them a good or service. You might owe them like money. For instance, if someone lent you or gave you a loan, you would owe them money, right? That's a liability. Whereas shareholders' equity is the residual amount that is left over, right? Assets minus liabilities. If you rearrange this equation, assets minus liabilities equals shareholders' equity. So shareholders' equity is really the residual amount that is attributable to the equity holders of a company. So you can really just think of this as like the assets and then the claims on those assets. For instance, like let's say I buy a $1 million house and I fund it with 50% debt. I take on a $500,000 mortgage, and then the rest of the money I put up myself. I would have liabilities of 500K, right? Because I owe the bank 500K. But then I would also have equity of $500,000. That's the money I actually put in myself. That is what is attributable to me, right? So that's how a balance sheet would work, and that's that core equation. So now I'm going to be going through each of the financial statements and just going down each one and talking about all the line items that are on each statement. So the income statement at its core is showing all of the revenue generated by a business's core operations, and then of course all of the expenses related to running the business during a period of time. And it's important to note it is businesses that they own more than 50% of. So if you own more than 50% of the business, then it shows up on your statements. So for instance, if I am looking at a stock that owns 90% of some business, this would show up on the income statement. But let's say Warren Buffett, right? Warren Buffett, his company, Berkshire Hathaway, they own 8% of Coca-Cola, right? 8 to 10% of Coca-Cola. What Coca-Cola generates in revenue, that company does not show up on the Berkshire Hathaway income statement because they don't own more than 50% of it. So it's not a core business operation. Whereas like the railroad company that Berkshire Hathaway owns, which they own 100% of, that actually shows up on the income statement because they own more than 50% of it. So again, core operations. So for instance, if I own a lemonade stand company, but I put some money into the lottery and I win the lottery, that money would not show up as revenue. That would show up as other income, which I'll talk about later on the income statement. Revenue is just core business operations. Just wanted to make sure to emphasize that. So as I kind of gave away, we start off with our revenue, right? That's just what we're bringing in from our core business operations. It's the money that we're getting during this period, right? The amount of goods or services we're offering. And I'll get into the difference between accrual and cash basis accounting in a minute. But for now, it's just the goods or services that you're selling and how much that's worth, or how much you're getting paid. And then you have costs of goods sold. And that is expenses that are directly related to the revenue that, to the revenue that you're generating, right? So, and this is also shortened, the abbreviation is COGS. So for instance, like a lemonade stand, what are the expenses that are directly related to me selling lemonade? Well, it's the lemonade itself, right? That is a direct expense. Or maybe the labor that goes into selling that lemonade. It's a direct expense. Whereas like the CEO of my lemonade stand company, that's not a cost of goods sold because that's like a general operating expense. Same with like insurance or rent expense, right? It's not directly related to the business, right? Depending on what the rent expense is. But that is cost of goods sold. And then revenue minus that is gross profit. Revenue minus COGS is gross profit. So gross profit is really showing like the unit economics of your business, right? I'm selling this many units of something, and then each unit costs me this much. So cost of goods sold, you can kind of simplify as just like the variable costs of the business. So if a business has negative gross profit, obviously that's a very bad sign because it's like, that'd be like if I had a lemonade stand where I sell lemonade for $2, but it costs me $2.50 to make each cup. Like that's a business that just isn't sustainable unless in the future the business is going to be able to raise their prices or cut down costs. That's just a very bad business, right? A company could be unprofitable, but if their revenue is higher than their variable costs, if they just grow revenue by a large enough amount, they could become profitable. But if a company has negative gross profit and they can't fix one of these two things, obviously it's a very bad sign. I kind of gave this one away, but next one is operating expenses. So these are things like SG&A, which stands for Sales, General, and Administrative. That's basically like marketing or paying general employee wages, right? Like the corporate salaries, right? Not like the direct employees. Things like that, right? Paying insurance, paying rent. You also have R&D, which is research and development. So that's like research and development, basically what it seems like Apple would have a lot of R&D into like their new product offerings, try to innovate. And then the last one is depreciation and amortization. And this one can actually fall into OpEx or cost of goods sold, depending on what the depreciation actually is, right? Depreciation is the expense that happens when tangible assets go down in value. Amortization is the expense that happens when intangible assets go down in value, so like a patent, for instance. If the depreciation is something directly related to what you're doing, for instance, like a factory that's depreciating, and that factory is where your goods are produced, that would probably qualify as cost of goods sold. Where if it was just like your corporate office building and that was depreciating, that would probably show up in OpEx, because that's more just related with your business as a whole, and it's not like a direct cost. So after OpEx, you get to operating income or operating profit. And this is really basically your revenue minus all of your fixed and minus all of your variable costs. This is showing like basically from just my core operations before I pay any taxes or interest or any other miscellaneous things, like, am I a profitable business? So this is a nice thing for just looking at, is this business like sustainable? Of course, maybe a business has very good gross profit, but they have negative operating income. What would that tell me? Well, that tells me that I need to have a lot more sales, because if I have, more, if I'm charging more for my service than like the variable costs, and I have positive gross profit, but I have a certain amount of fixed costs, typically my OpEx, that means that if I just increase my sales by enough, then hopefully this will outweigh these OpEx, and then I'll have positive operating income. So that's just kind of something I would think about when you're thinking about just businesses as a whole. And that's part of the reason why like Amazon wasn't profitable till recently. Of course, Amazon had positive gross profit, but they had just so much of this, right? Because they're doing so much research and development into their different product lines, right? Amazon Web Services, Whole Foods, right? They acquired that, all these different things. So they have a lot of fixed costs essentially, but now they have positive operating income, and hopefully they'll be able to continue scaling, and they'll have very good gross profit, and then hopefully, positive operating profit. They'll continue having that. So that's why Amazon's a very valuable company, even though for a long time they had negative operating income, just because of the potential once they grew their sales enough, which of course is called operating leverage. But I can go into that more in another lesson. So now you subtract out, well, I guess I'll do add and subtract. You add interest income, right? If, for instance, you have a US Treasury, you bought some bonds or like some kind of short-term asset that pays out interest, then of course you're getting interest income. And this doesn't show up as revenue because it's not related to your core business activities. So it goes right here because you still have to get taxed on it. But the other thing is interest expense, right? Maybe you took out a loan, so you have to pay interest on that loan. Then that would mean that you have an interest expense. So you add or subtract that depending on what it is. And then you also add other income, which is basically things from like non-core operations. So this could be, for instance, like if you won that lottery ticket, that would go in here in other income. And then this gets you to your pre-tax income. And then after pre-tax income is, of course, taxes, right? You're subtracting taxes, and then that gets you to your net income. So that's basically the income statement right there. You're just going from your revenue to your net income. Here's an example income statement, what that would look like. You can see here revenue minus COGS, gross profit, minus OpEx, which I broke up into SG&A and D&A, gets us to operating profit or operating income. And then you subtract that interest expense, pre-tax income gets you to that, subtract taxes, net income. So make sure to memorize all these line items. Now I'm just going to be going over accrual basis accounting versus cash basis accounting. So the income statement is done on an accrual basis rather than a cash basis. And this is an important concept to understand because it's really important for thinking about like how these three statements flow together. So basically, the thing to understand here is that on the income statement, revenue and expenses are recorded when they are earned or incurred, regardless of when the cash is actually received or paid. So the income statement, rather than just showing how much cash did I get, it's more so showing, okay, during this period, how many goods or services did I actually sell? And then what were the costs directly associated with this period, right? Not just like costs for another period. For instance, like, I'll give a few examples here. Let's say it's January. I operate a lemonade stand, and a lady pays me $20 for 10 free cups of lemonade in February. Well, I'm getting the money in January, but she's actually gonna buy the cups in February. So what would happen is this would show up as revenue in February because it's accrual basis on the income statement. Accrual basis is when revenues and expenses are recorded when they're actually earned or incurred. Second example, a man buys $10 of lemonade from me and promises to pay for it in February. This is the opposite, right? He's buying it right now, but not paying for it until the next month. So it would show up as revenue in January. The same thing here. So I buy lemonade inventory and sell it in February. So of course, as a business, I'm having to pay this expense in January, but I'm not actually selling the lemonade. I'm not actually incurring that expense, which would show up in COGS until February. So this would show up in February. So basically, that's how I think about accrual basis accounting. Obviously, the cash flow statement, that's just all about when is cash actually coming in and out. The income statement is more of when am I actually, earning or incurring these revenue and expenses. So that's kind of the framework for thinking about the income statement versus the cash flow statement. Now I'll go into the cash flow statement. So there's three main segments. First is cash flow from operations, which is basically abbreviated as CFO, and it's showing the cash flow generated just from operating the business during a certain period of time. So I'm just going to go through all the line items here. So, of course, as you can imagine, there's some discrepancies between the income statement and the cash flow statement. For instance, right here, the lady is paying me $20 in January. So in January, I'm getting that money, but it's not actually showing up on my income statement until February. So there's a discrepancy here between how the accrual and cash basis accounting is working. So we kind of basically correct those discrepancies in the cash flow statement to actually show what is the actual cash coming in and out of my business during this period, right? And then we also have to add back things that are like non-cash expenses, which I'll get into right now. So the first thing you always have on cash flow from operations is your net income. So whatever your net income is, it flows to the top of the cash flow from operations segment. And then you add depreciation and amortization. Why? Because this is a non-cash expense. You also add stock-based compensation, which I'll abbreviate as SBC, because stock-based compensation is also a non-cash expense. It's showing up on the income statement. It's lowering my net income, but it's not cash, right? D&A, that is a fictional expense. Of course, I'll get more into D&A in a second, but it doesn't cost me money when an asset is depreciating because I already bought the asset a long time ago, right? Every year my house goes down in value because if I haven't done any repairs because it's just getting older, but I don't actually lose money when that happens. Stock-based compensation, similar thing. I'm paying my employees in wages in stock instead of just cash. So even though it shows up as an expense on my income statement, it's not actually lowering my cash. We also add back asset write-offs and write-downs, which I'll go into the difference in a second. But basically, this is when an asset that I have has gone down a lot in value, and I actually write it off or write it down, which shows up on the income statement. But this, like D&A, is non-cash, so I need to add it back because it's lowering my net income, but it's not actually costing me money. Another thing is gains and losses, which I'll also get into, but basically just know that these are not actually related to your operations. So they're showing up on the income statement when you sell an asset for more than it shows up as it being worth on your balance sheet, or vice versa. If you sell it for less, it shows up as being worth on your balance sheet. But this is not actually related to your operations. It's more so related to the next section on the cash flow statement, investing. So you would want to subtract gains and add losses to reclassify it to that section, but I'll get into that in a second. So that is another thing. You also would add back, PIK interest, because PIK interest is interest that you're not actually paying in cash. It stands for paid in kind, so you're not actually paying it in cash. I'll get into more so how that works mechanically in a second as well. Trying to think, is there anything else I'm missing? Oh yeah, this one kind of falls in the same bucket as asset write-downs. Goodwill impairment. I'm not really going to elaborate on this one until later in the video, but just know you would also add that. And you also subtract and add DTAs, deferred tax assets, and DTLs, which I'll also get into later in the video. And then you'd also want to subtract change in operating, networking, capital. That's the last thing, which I'll also get into in a second. So these are, you kind of want to make sure when you're kind of reviewing for interview technicals that you know all whatever 8 or 9 of these and how they all flow through the 3 statements. Because if you get asked, you could easily get asked about one of them, and I'm going to go through each of them specifically in a little bit. But that's just the cash flow from operating section. Investing section, I guess I already wrote it down, but basically cash flow from investing is showing the cash flow from investing, so buying and selling both short-term and long-term assets. Cash flow from financing, I'll write out the line items in a second, is showing the cash flow from the financing activities of the business, so like raising capital, like debt and equity, and then paying back those stakeholders. So these are the cash flow from investing line items. It's pretty simple. There's CapEx, which of course is buying long-term tangible and intangible assets. And that's a cash outflow, right? That's why you're subtracting it. And then this one, that's buying like short-term assets. Like for instance, like government bonds, that is a short-term asset. It's also a cash outflow. And these are the opposite. Proceeds from selling a long-term asset. Like if you sold a subsidiary company from your business, you'd be getting proceeds from that. Same if you're selling like a short-term US Treasury bond, you're getting proceeds from that. So cash flow investing is definitely the simplest section. And then cash flow from financing, there's 5 main ones I'd note here. Obviously, there's just debt issuance. That's just like raising money through debt. You make money, it's cash inflow. Equity issuance, same thing, except instead of raising debt, you're raising equity. And then there's 3 cash outflows, 3 primary ones. Dividends to your common or preferred equity holders. Stock buybacks or share buybacks is also a cash outflow. Both of these are just returning cash to your stockholders, right? Either in the form of dividends or buybacks. And the last one is debt pay down. So not interest expense. Interest expense shows up on the income statement and is tax deductible. None of these are tax deductible, right? When you pay it down, it doesn't show up on the income statement. All of these just show up on the cash flow from financing segment. So those are the 3 segments or sections. You have cash flow from operating, cash flow from investing, cash flow from financing. And then you add up all those segments or sections, I don't know which one, and then you get the total net change in cash. So now going through the balance sheet. So let me erase these real quick. Again, the formula here is assets equals liabilities plus shareholders' equity. So that is the fundamental equation. Just always think back to the house example. So there's 2 kinds of assets and liabilities. You have current assets, and then you have non-current assets. Non-current assets are assets that you can use for less than a year. Current assets are assets that you could liquidate easily in less than a year. Non-current assets are more like longer term assets, less liquid. So examples of current assets, that could be cash, short-term investments, and then also things like accounts receivable or inventory, and prepaid expenses. Those are the main ones. And non-current assets, that's things like PP&E, which stands for plant, property, and equipment. These are like long-term tangible assets. You also have intangible assets, goodwill, which I'll get into in a bit. You have deferred tax assets. I might be missing one, but I think these are the also like long-term investments. So maybe if you like made a long-term investment into like an apartment complex, that's like not very liquid. It's a long-term investment. Should show up as non-current assets. So these are all the assets on the left side of the equation. And then you have liabilities, which I always struggle to spell, but liabilities, same thing. You have current and non-current liabilities. Current liabilities, you can have short-term debt or short-term lease obligations, short-term leases. And then also you have like accounts payable, accrued expenses, I can't spell that. Accrued expenses and deferred revenue. So these are all things that are kind of due in less than a year, things you owe to external third parties. And in the next year. For instance, short-term debt is just like the debt that you have to pay off in the next year. Leases are just like the rent payments that you have to make in the next year. And I'll define the other three on the next slide. Non-current liabilities, those are things like long-term debt or long-term leases, or deferred tax liabilities, right? All of these things would qualify as non-current liabilities. And I guess you could also have like a long-term deferred revenue or long-term like accrued expenses. So moving on here, let me see. Lastly, you have shareholders' equity. So that is basically, you have your assets and your liabilities, and shareholders' equity is like the residual amount, right? That's what's left over for the equity holders. And how it works is shareholders' equity is not actually indicative of what like the actual equity of the company is worth. It's more just like accounting purposes. And that's just the spiel I'll go on right now, I guess. It's just like the value that things show up on the income statement or on the balance sheet is not necessarily what they're actually worth. For instance, if you buy a house, which would qualify as PP&E, it's a tangible long-term asset, it's going to show up on the balance sheet at whatever you paid for it. So if you paid $1 million for it, it's going to show up as $1 million and then slowly depreciate over time, right? So maybe 5 years in, it's worth $800,000. But in fact, the house has probably gone up in value over time, especially if it's in a, flourishing area like Austin, Texas, for example. So despite that, it would still show up as $800,000 on your balance sheet, even if you could really like pay it or sell it for $2 million if you wanted to. So the book value of assets, which is just shown at cost, whatever your company actually paid to acquire them, is not indicative of the true value of them. Same as shareholders' equity. Shareholders' equity is basically split up into three main sections. You have your common stock / additional paid-in capital section. Don't worry about this is just like an accounting concept that is not important for finance people, but basically just think of this as how much was raised in cash through equity issuance, right? This is just like, if you raise $1 million, it doesn't matter if your company's worth $1 billion now. This is just however much you raised in cash through equity or stock issuance, right? Then you have retained earnings, and retained earnings is just cumulative net incomes minus cumulative dividends. So it's basically how much profits have I had over time throughout the entire course of my company, minus all the distributions that I've made to my shareholders in the form of dividends, right? So your retained earnings is basically, okay, how much of my profits have I not paid out yet to my shareholders, right? This is kind of like the box that I haven't unlocked yet that my shareholders could potentially get in the future, right? Because I have these profits, but I haven't given them back to my shareholders in the form of dividends. And then we have lastly, treasury stock. So it's common stock plus APIC plus retained earnings. And then you subtract treasury stock. And treasury stock is just money spent buying back shares. So it's basically the same thing as a dividend, at least the cash effect on the company. When you buy back shares, you're just returning cash to shareholders. It's just like if you pay dividends. So you can really think of shareholders' equity as just how much have I raised from issuing equity plus how much have I made in net income over the entire course of my company. So how much have I raised plus all my net income minus the amount of cash I've paid back to shareholders in the form of dividends and then share buybacks. So this is an example balance sheet. Of course, the most important thing with a balance sheet is that it balances, and thankfully this one does. But yeah, you just have your assets and it equals your liabilities plus your shareholders' equity. So in this case, on shareholders' equity, I raised $70, I guess, in common stock and APIC. I've bought back $10 worth of shares. And then I've also have retained earnings, so cumulative net income minus dividends of $40. And then I have some short-term liabilities and then also some long-term liabilities. Like I have some long-term debt. So yeah, this is what a balance sheet looks like. To continue on, here are a few important financial ratios and just like non-GAAP items / metrics. So a really important metric to look at when you're thinking about companies and stocks is earnings per share. And it's basically net income divided by the amount of shares outstanding you have. Shares outstanding is just the amount of like shares you have outstanding to your stockholders, right? So if you have 100 shares outstanding, that means that if someone owns a share of your company, they own a 1% stake in the equity of your company. So earnings per share is important because it shows over time how much of the net income attributable to me as a shareholder. It shows how that's actually changing, right? Because you could look at just how much net income is changing, but it's also important to combine that in conjunction with shares outstanding. For instance, like if a company's buying back shares, that means that net income doesn't have to increase by that much because you are owning a larger and larger portion of the company as the company buys back shares, right? If a company went from 100 shares to 50 shares, then that means your stake went from 1% to 2%. So even if net income didn't grow, your EPS would have doubled during that period. You have a double the claim on the company's earnings as you did before, right? So that's why EPS is important. And it could be the opposite, right? If a company is issuing a lot of shares in the form of like stock-based compensation, then EPS could be going down even if net income itself is going up. So you have to look at the numerator and denominator in conjunction with each other. Next thing is gross margin, operating margin, and net margin. And margin is just like profit over revenue. So it's like, okay, for every dollar of revenue, how many cents am I getting in profit? Gross profit, operating profit, and net profit or net income, right? So it's basically showing like, based off of this much revenue I'm generating, like how good is that as far as like profitability goes? For instance, if a company has a 50% gross margin, that means for every $100 of revenue, you get $50 of gross profit. So that means that like that basically just means that your expenses are half of what your direct expenses are half of your revenue. If your net margin is 10%, it's the same thing. It's like 10 cents on the dollar of profit for every dollar of revenue. Next thing is EBITDA, which is a metric you'll probably hear a lot. People say EBITDA, EBITDA, but I say EBITDA, and it is basically earnings before interest, taxes, depreciation, and amortization. And it's basically a proxy for unlevered free cash flow, which is basically the cash flow attributable to all stakeholders, which I'll get into more next time. And it's used a lot in valuation and mergers and acquisitions, even though it's non-GAAP, right? Companies don't have to report this metric, even though a lot of them do. It's kind of like a made-up thing. It doesn't actually show up on a financial statement, but investors still care about it. And then you also have adjusted EBITDA, which is basically EBITDA plus more line items that are added back. Maybe a company, they don't just want to add back interest, taxes, depreciation, amortization. They also want to add back stock-based compensation or asset write-downs, right? Because basically EBITDA is a good way to show your normalized profitability, because D&A is non-cash. So you can make the argument that we really shouldn't care about D&A. Taxes change a lot, and an interest expense is attributable to your debt holders. So it's not really relevant if you're looking at things on an unlevered basis, which I'll get into next time. So you can make the argument like maybe we should be using EBITDA instead of net income as an investor, but I would caution you to rely only on EBITDA, because sometimes EBITDA can be manipulated, especially because even though D&A is non-cash, a company still has to make mandatory capital expenditures, right? Which do cost the company cash. A company has to make capital expenditures to continue to make sure their long-term assets are performing well. So if they stop doing that, the company will fail. So that kind of needs to be considered when thinking about cash flow, and EBITDA does not consider that. Adjusted EBITDA can even be more dangerous because you're adding back things that are seen as like one-time charges, even though a lot of times they aren't one-time charges, and you might actually be facing those charges a lot, right? For instance, like a company might say, hey, we're going to add back our restructuring costs. So it's EBITDA plus that. So basically EBITDA plus restructuring costs. And they might be like, this is just a one-time expense. But if you look at the company's financial statements, they pay that expense like every year for the last 10 years. So clearly it's not a one-time expense, even though they're saying it is. Some other important metrics are debt to EBITDA. So that's just showing how much your debt is over your cash flow. So if like your debt to EBITDA is 5x, that means it'd probably take 5 years of cash flow to pay off your debt. And then interest coverage ratio is just your EBIT over your interest expense. So basically, EBIT is just earnings before interest and taxes. So it's right before you pay your interest expense. And this is just showing like how strong you are as far as like making your interest payments goes, right? For instance, let's say that I have student loans, and that after I pay my rent expenses and my food expenses, I have like, let's say $20,000 left in income. And let's say my student loans have interest of $200,000 or $20,000. Like, that's not very good, right? I have to pay the exact same amount of interest as my income every single year. Like, I can't use any income to like invest in myself or like go have fun. So when a company has an EBIT to interest expense like below 1.5 or 2-ish, it starts to be a little bit of a concern. Back to that student loan analogy. Another thing is that people kind of like say, but isn't actually true, is EBIT equals operating income. For most practical purposes, you can say that's true, but in reality, it is a little bit different because operating income is revenue minus all fixed and variable costs, right? It's just like this on the income statement, right? It's just like revenue minus direct costs, right? COGS or variable costs, and minus OPEX. But EBIT is net income plus interest plus taxes. So while they might look different, when you have things that are non-operating but not interest and taxes, they have different effects on both of these metrics. For instance, let's say we have an asset write-down of $10. That won't lower my operating income because it's not related to my operations, but it will lower my EBIT because it's not earnings before interest, taxes, and asset write-downs, right? So it will lower my EBIT by $10. So that's why a lot of times companies report adjusted EBIT or adjusted EBITDA because they want to add back these like non-cash things like an asset write-down. But I just caution you against saying EBIT equals operating income in all cases because they're not technically the same. Here are a few like interview questions you could potentially get. First is just like the classic, like walk me through the 3 financial statements and how do they link. Basically just talk about how you on the income statement, like what is it? You go from revenue to net income, and net income flows to the top of the cash flow statement. And then the cash flow statement is like basically cash basis, while the income statement is accrual basis, and how like the cash flow statement kind of connects the income statement and the balance sheet. And the final line item on the cash flow statement is net change in cash, which flows to the balance sheet under assets, right? Because cash is an asset, a current asset. And then also in the balance sheet, your basically everything on the cash flow statement flows to the balance sheet in some way. Like for instance, if you take on more debt, that'll show up on the cash flow statement, but then it will also show up on the balance sheet as you having more cash, and then you also having debt under your liabilities. So just talk about how the cash flow statement flows to the balance sheet a lot, and then also your net income on the income statement flows to your shareholders' equity under retained earnings, right? Because retained earnings is all the net incomes minus all the dividends. So whatever your net income is gets added to retained earnings, so under shareholders' equity. Another question is, if I was on a deserted island and could only see one financial statement, which one would it be? The answer is the cash flow statement, because like at its core, what's really important to us as investors is like, is this business actually generating cash? And the cash flow statement generates, or the cash flow statement shows us that at its core, right? Whereas the other two can be more easily manipulated. What if you could only see 2? That would actually be the income statement and the balance sheet, because you can actually form the cash flow statement from an income statement and a balance sheet. So you could actually, if you had those 2, have all 3 basically. So if you could see 2 on a deserted island, you would want the income statement and balance sheet. Why could a company with positive EBITDA for 10 years go bankrupt? The answer is EBITDA doesn't equal cash flow, for one. So you could have positive EBITDA, but negative cash flow. Another reason is a company could just have a lot of debt, right? Maybe your EBITDA isn't that positive, but you have a ton of debt. So you just can't make your interest expenses, or you can't make your mandatory debt repayments, so you go bankrupt. Or maybe you're like Hawaiian Electric, the company that's getting sued because of how they operated during the Maui hurricane recently. You could have like a huge tort claim or lawsuit against your company, and you just can't pay it, so you have to go bankrupt. So those are some reasons why a company with positive EBITDA could go bankrupt. I'll talk about depreciation in a second, and then you also will get a ton of like these walk me through this 3 statements if questions. So I'm going to go through like basically how that works for like a lot of these specific examples, and I'm going to go through that very quickly. I'll try to get that done in the next 20 minutes. So first, let's just talk about D&A. So D&A happens because when a company makes capital expenditures, so basically long-term investments into tangible and intangible assets, it shows up on the cash flow statement under cash flow from investing, but not on the income statement, right? And the reason for this is that these tangible and intangible assets that the company is investing in can be used for more than 1 year, right? If I buy a stand for my lemonade stand and I can use it for 10 years, it doesn't make sense to only count that expense for the first year I can use it. It makes sense to spread that across the actual 10 years I can actually use it, right? It'd be unfair otherwise to say, oh, it only shows up as an expense for this 1 year, and then it's free for me the other 9 years, because it's going to basically unnormalize our earnings. And 1 year is just going to be a huge expense and the others wouldn't have it. So because of how accrual accounting works, we basically spread out this cost across the amount of years we'll actually be using this tangible or intangible asset. So for instance, if we buy a $1 million factory with a 10-year useful life and no salvage value, so it's worth nothing at the end of these 10 years, then that would mean that we incur $100,000 of depreciation per year, which would show up on the income statement. And it's important to remember that D&A is a non-cash expense. When you're making this capital expenditure upfront, it's actually costing you cash. But when you basically capitalize this expense over the 10-year period, it's not actually costing you any cash. It cost you the cash when you initially bought it, but now it's not costing you anything. So I'll get into how that works mechanically. So 3 variables that determine how much per year an asset is depreciated are the amount that we spent to invest in the asset. So that's just like the book value of the asset at cost, right? Whatever it costs you, the useful life, and then the salvage value. So you could basically, the equation basically is the value of the asset minus the salvage value divided by the useful life. So basically, book value minus salvage value, parentheses, divided by useful life. Sorry, divided by useful life. So for instance, I'll go through this example here. Let's say in year 0, I buy a factory using 50% debt and 50% stock for $100. Walk me through the 3 statements. So this is a classic problem, and it's year 0, so the asset hasn't actually depreciated yet. So I'm only going to report things on the cash flow statement, because just buying an asset does not affect my income statement, right? This is how accrual-based accounting works. On the cash flow statement, nothing happened to my operating activities. In my investing activities, I had CapEx of $100. CapEx is a cash outflow, so CapEx of 100, so we're down 100. And then in CFF, cash flow from financing, we had debt issuance of 50, which is a cash inflow, and then equity issuance of plus 50, which is also a cash inflow. So basically, if we net out everything, it's minus 100 plus 50 plus 50. So there's no change in cash. So we go over the balance sheet. What you always do is first see what happened to cash. Cash, nothing was affected, right? It's still at 0. Your PP&E is up 100 because you bought an asset, a long-term asset, for 100. And then you have on the liability side, this is your assets here. And on your liability side, you have debt, long-term debt, right? Plus 50. And then under your shareholders' equity side, you have your common stock / additional paid in capital is up 50 as well. So this is how this works mechanically when you buy a factory using 50% debt and 50% stock for $100. Now let's say that it's year 1, and let's say for the sake of this problem, this debt has no interest expense. And let's say that the factory has a salvage value of $50 with a 5-year useful life. So basically I do $100 book value minus salvage value 50 equals 50. Divided by a 5-year useful life means that we are going to incur $10 of depreciation expense per year. So basically what this looks like is, and actually let's say there is some interest expense. Let's say there's a 20% interest with 20% interest, just so we can see what interest expense looks like. So basically what happens here is factory has a salvage value of $50. So remember, $10 of depreciation, and we have 20% interest on $50 of debt. So we're gonna have $10 of depreciation, $10 of interest expense. So minus 10 depreciation, minus 10 of depreciation. And then we're also gonna have minus 10 of interest expense equals pre-tax income of down 20. Assume a 40% tax rate. 40% tax rate of 20 means that we're going to actually have positive, or we're going to have a tax benefit because we have a negative amount here. So we're going to actually have plus 8 in taxes. So net income of negative 12. And just a reminder, when you're doing these problems, it's always like the net change. So it's not actually, okay, like my full income statement. It's just because of this action, right? What actually just happened incrementally, right? So my company probably had revenue this year and probably had some costs, but I'm only seeing based off of these things what happened. So that's what happened on the income statement, we always have the net income of negative of whatever flow to the top of the cash flow statement. So it'd be negative 12 net income. And then we add depreciation because it is non-cash. So we're gonna have negative 12 of net income, and then we're gonna add back the depreciation of $10. So it's gonna be equals negative 2 CFO. There's no other changes across the cash flow statement. We go over the balance sheet like last time. Assets, we have cash, that is down 2. And then we have PP&E, which is down 10 because it's depreciated, right? Our net PP&E, which is basically the total amount we bought it for minus the depreciation. So that's negative 10. So our assets are down 12. And then we have our shareholders' equity, which is also down 12. Retained earnings, our net income is down 12. And you can see here, if we did not have any interest expense, let's say for the sake of this, we didn't have any interest expense. So instead our pre-tax income was 10, and this was just wiped. And then we had net income of negative 6 if there was a 40% tax rate. And then we added negative 6 plus depreciation. We would actually have positive net change in cash, right? Which is weird, right? Because you're like, wait, depreciation is non-cash. Why did we have positive net change in cash? Well, it's because of the tax benefit of having depreciation. Depreciation lowers your net income, which is then a tax benefit for you, which is very nice. So then when you actually incur depreciation, you're actually gaining cash because of this tax benefit. So that's what happens when you have a $10 increase. Decrease in depreciation is just the opposite, right? When you have a decrease in depreciation, you have plus 10 in pre-tax income because you have less depreciation. You pay taxes on that, so net income is 6. In cash flow statement, plus 6 net income, plus 6 net income. You subtract the depreciation because this benefit is non-cash. So you actually have a negative 4 net change in cash because you're just having to pay more taxes. And then it's the same thing as last time, negative 4 cash. PP&E is actually up 10 because you had 10 less in appreciation. And this balances with 6 and shareholders equity from your retained earnings. So that's your depreciation and amortization there. Now I'm going to get into net working capital, which is a very important concept. Net working capital is basically current assets minus current liabilities, and it's a metric that measures a company's near-term liquidity. Operating net working capital is so there's net working capital, which is just current assets minus current liabilities. And this is the metric that shows companies' near-term liquidity, right? This is basically just like, can the assets that are easily able to be liquidated into cash, can that meet all of the liabilities that I have coming due in the next year? So it's measuring near-term liquidity. Whereas operating net working capital is more so used in a discounted cash flow valuation. And I'll get into that, the importance of this next week. But it's basically only showing your current assets minus current liabilities that are operating. And it's very important in that unlevered free cash flow calculation, which I won't get into now. But basically, it's important to know that there are 3 main current operating assets: accounts receivable, inventory, and prepaid expenses. And then 3 main current operating liabilities, which is accrued expenses, accounts payable, and deferred revenue. These are very important. They get asked about a lot when people are like, walk me through the 3 statements. So I'm going to get into what each means and then what happens when each of them go up or down. And then if you're wondering some examples of non-operating current assets, this would be like cash and short-term investments, and then also like short-term debt and short-term leases. Because while these are, actual obligations and actual assets, they aren't related to the company's core operations. So when you're calculating an unlevered free cash flow, these things are not related to it, while these operating current assets and current liabilities and how they behave are actually related to it. So let me just define these operating current assets now. First, we have accounts receivable. Accounts receivable is basically just revenue we have generated but not been paid in cash for. So basically, if I stumble someone lemonade but they haven't paid me in cash yet, this is an asset for me because they owe me money and I've already provided them the good or service. Prepaid expenses is expenses we prepay for. So now we are owed a service. So for instance, if you prepay your rent expense or your insurance expense, this is an asset because now you're going to get it for free, right? If I pay for a concert 3 months in advance, this is an asset for me because now it's free for me now, right? Even though I paid for it in the past, it's free for me in that, I'm now owed this service from the concert people. And then in the inventory, it's just, let me see what's going on here. My computer's tripping. What the heck? Sorry, I don't know what's going on. Having some technical difficulties with my computer. Let me see here. All right, sorry about that. It's working now. Inventory is just things that we can sell that are already made and parts of our core operations, right? If I'm a lemonade stand, the inventory is just the actual lemonade. So now I'm going to quickly go through the three statements for all these. So actually, first, I'll define the current operating liability. So we have deferred revenue, which is basically unearned revenue. So basically, when we get paid in cash for a good or service we have not delivered yet. Accrued expenses is expenses we have incurred but not paid for in cash yet. So this is basically like, if I owe my employees some wages, or I owe my insurance payment, or I haven't paid rent yet, I've accrued these expenses, I've incurred them, but I haven't actually paid them in cash yet. Accounts payable is money owed to vendors, usually for like inventory. For instance, like if I get my lemonade from HEB and then I sell it at my stand, if I owe HEB for the lemonade, I haven't paid them yet, this would be accounts payable. The key difference between accrued expenses and accounts payable is that accrued expenses is an expense that's actually like you've incurred on the income statement, right? For instance, like operating expenses, it's normally related to your operating expenses, like rent or insurance or paying your employees. Where accounts payable, you usually haven't incurred yet on the income statement because you haven't sold the inventory yet. And if you have sold the inventory, it shows up in your COGS. So this is more related to your COGS, and it usually doesn't show up on the income statement, where this is more related to your like operating expenses, and you have incurred it on the income statement. So now let me go through what happens to the three statements for all these. I'm going to go through this very quickly. So just pay attention. So accounts receivable up 10. So what happens when accounts receivable is up 10? We've generated revenue, but we haven't been paid for it yet. So we've generated it though. So it shows up as revenue of $10. We're going to assume we have no variable expenses with this revenue, but you should probably clarify with the interviewer that that's the case. So we're just going to assume that this flows all the way down to pre-tax income, revenue of 10. So pre-tax income up $10. We pay taxes, so net income is up 6 if we pay 40% taxes. Then CFO, always you have net income flows $6, and you have to just always think of it like a 10-year-old when you're doing the cash flow statement. When we think about this, did I get any cash here? No, I haven't been paid for this good or service yet. So I got to subtract out the $10 of accounts receivable. Accounts receivable is a cash outflow when it goes up. But when it goes down, when your accounts receivable goes down, it's a cash inflow, because imagine that accounts receivable going down means that now you're actually being paid for the good or service that you previously gave to someone. So that means that it's a cash inflow, but when it goes up, that means it's cash outflow. So this equals -4, equals -4 net change in cash. Whereas this equals, I didn't finish the problem. So balance sheet, we have assets of -4 cash. We have AR, right, which is accounts receivable. It's up 10. So our assets are at 6, and then this balances with our shareholders' equity, which is also at 6, because that's what my net income was. Prepaid expenses, where does it show up on the income statement? That's a trick question. It doesn't show up on the income statement because we haven't incurred the expenses yet, and the income statement uses accrual basis. So it doesn't show up on the income statement because we haven't incurred the expenses yet, but it is costing me money. So on the cash flow statement, prepaid expenses of $10, that's a cash outflow. I'm losing money through this. That's the only thing that happens. And then -10 in cash, but plus 10 and prepaid expenses. So it balances out. I have -10, but plus 10 in prepaid expenses. So it balances out. So my net change in cash is 0, right, on my balance sheet. If prepaid expenses goes down, then that would mean that it's a cash inflow because it's showing up as an expense on my income statement, but I've already paid for it in cash. So it's a cash inflow. I didn't actually have to pay for it in cash, even though I incurred it on my income statement. Inventory, if you buy inventory, it doesn't show up on your income statement because you haven't actually sold the inventory yet. So when you buy inventory, what happens is the same thing as prepaid expenses. Shows up as -10, inventory of 10 is a cash outflow, -10. And you go to the balance sheet and you have $10 or -10 cash, but +10 in inventory. So it balances, right? You have -10 cash, but +10 in inventory. So it balances. And what's the pattern with all of these? The pattern is whenever a current asset goes up, it's a cash outflow, right? Because basically what's happening is you're receiving this asset and in exchange, you're basically losing cash. It's the exact opposite when a current asset goes down. When inventory goes down, that means that you're selling the good or service, but it didn't actually cost you cash. So that's a cash inflow for you. Prepaid expenses, you're incurring expense, but you already paid for it in cash. So that's a cash inflow for you. Accounts receivable, when it goes down, that means that you're actually getting paid for the good or service you previously produced. So cash inflow when it goes down, cash outflow when a current asset goes up. It's the opposite for current liabilities. Hopefully the slide works. What happens when deferred revenue goes up? When deferred revenue goes up, it doesn't show up on the income statement because what's happening is you're getting paid for a good or service you haven't produced yet. So if you haven't produced it yet, it doesn't show up on the income statement. So what happens is you have CFO, you have 10 in DR, deferred revenue, and that's $10. You get money, right? Because you're getting paid, but you haven't produced a good or service yet. And then on the assets, you have 10 in cash, and liabilities, you have 10 in deferred revenue. So very simple. When deferred revenue goes down, though, you actually have to put it on your income statement as revenue. But the thing is, once it goes down, you've already gotten the cash. So this is actually a cash outflow for you because it shows up that you have revenue, but you didn't get it in cash because you already got it in cash. So it's a cash outflow when deferred revenue goes down, but a cash inflow when it goes up. Accrued expenses, what happens when accrued expenses goes up? It's the opposite of prepaid expenses. It shows up on the income statement. So on the income statement, you have $10 in OpEx. So pre-tax income down 10. So net income is down -6 because of the taxes. So you're actually incurring an expense, but it's accruing. We haven't paid for it yet. So that means that we have to add this back in CFO. So -6 in net income plus 10 in accrued expenses. So net change in cash is 4. Balance sheet, cash is up 4. Liabilities, though, we have 10 in accrued expenses. And then shareholders' equity, of course, we have -6 from the net income. So it balances 4 equals 10 minus 6, right? I'm supposed to call someone at 4, so I'm just going to quickly text them and tell them I'm gonna have to push back so I can finish making this video. So one Okay, sorry about that, y'all. All right, good to go. Hopefully this ends within like the next 10 minutes. Anyway, now going into accounts payable. So accounts payable, again, just money owed to vendors for usually things like inventory. So let's say, walk me through the 3 statements when accounts payable is up $10. So it's up $10. That basically just means, let's say it's up $10 to buy inventory. So what happens here is we're buying inventory, but we're not actually paying the vendor in cash. So this is not affecting the income statement because we're not actually selling the inventory yet. But in cash flow from operations, inventory up 10, which we already know is a cash outflow, but accounts payable up 10, which is a cash inflow, which makes sense, right? Because these are canceling each other out. The inventory is a cash outflow, but the accounts payable is a cash inflow. So overall, it equals 0. Because if you think about it like a 10-year-old, which is the trick, you didn't pay anyone cash, right? You got inventory, but you haven't paid for it yet. So basically, net change in cash should be zero, right? Because there's no tax implications either, because nothing is happening on the income statement. So that's what's happening here. And then you go to the balance sheet, and it's pretty simple, right? Inventory up 10 on your assets. So your assets are up 10, but accounts payable up 10 on your balance sheet. So your liabilities are up 10 as well. It balances. So what's the pattern here? Pattern here is when a current liability goes up, it's a cash inflow for you, right? Because basically you have a liability now, but because of that, you have a cash inflow, right? It's the opposite. When a liability goes down, now you don't have a liability anymore, but it's a cash outflow. So I would just like kind of have pattern recognition here. Just remember this. Whenever I'm doing one of these questions, I always just say, okay, so deferred revenue is a current liability. And when a current liability goes up, that is a cash inflow. Or if it's going down, you say, okay, so accrued expenses is a current liability. When a current liability goes down, that is a cash outflow. So I always just clarify that first, and then that helps me like do it in my head, because usually you can't like have paper when you're doing these. You got to do it in your head. So now let me get into, I think I stopped at stock-based compensation, or did I stop at PIK interest? I forgot. I'll go through these last few real quick. So first, let's just go through asset write-down. So these happen when a company decides that the book value of an asset is way above true value of the asset. So for instance, like, let's say I have like a $200 asset on my books, but in reality, this asset is definitely not worth $200. I would want to write down that asset to like reflect the true value of it. For instance, Texas French Bread, which is a restaurant in West Campus, they had their building burned down when I was a freshman. So they would need to write down that asset or write it off, because that factory or their building is not worth much anymore because it burned down, right? So that's an example of when you would need to write down or write off an asset. A write-off is when the asset is worth nothing now, whereas a write-down is when you're just writing it down to a certain amount, maybe from like 100 to 50. But like D&A, this is a non-cash expense, but it still shows up on the income statement. So like basically, just think about it like this, right? If I have a house and my house burns down, yeah, that sucks, but it didn't cost me any money, right? Yeah, I'm probably gonna have to build a new house, and that will cost me money, but the house burning down in and of itself did not cost me any money. So it basically works the exact same way as depreciation. It happens after your operating income, because this is not related to your core operation. So basically, you have operating income, and then you have like minus, you could have an asset write down. In this case, it's being written down from 100 to 50. So it's an asset write down of 50. So my pre-tax income is down 50. So then net income down 30, right? Assuming a 40% tax rate. I will say there's tax implications here as far as DTAs and DTLs go. I would check the Breaking the Wall Street guides for more information on that. But for the sake of most like very simple and intermediate accounting problems, just disregard that sentence. But there are tax implications here as far as like book taxes versus cash taxes. So you should probably take note of if you're doing like advanced interviews. But anyway, for the sake of this, net income is down 30, right? Because of this. And then you go to CFO and you have net income down 30 plus the asset write down. You add it back in cash flow from operations because it's non-cash, right? So 50. So then net change of cash from operations is up 20. And then after that is up 20, you go to the balance sheet, your cash is up 20, but PP&E is down 50, right? Because you wrote the asset down. So it's 20 minus 50, so assets are down 30, and then your net income is down 30, right? So your retained earnings is down 30, so it balances. So that's what an asset write-down is. Goodwill impairment is very similar. First, let me just establish what is goodwill. If a company acquires another company for more than the book value of the company's net assets, for instance, like Amazon acquired Whole Foods in 2017, and even though Whole Foods had like assets on their balance sheet of about $3 billion, Amazon paid, I think, around $10 billion to complete this acquisition of Whole Foods. So you can see here, just I'm paying $10 billion in cash for assets or net assets worth $3 billion. This is not going to balance on my balance sheet, right? I lost 10 billion of cash and asset for 3 billion of assets. So goodwill is basically the plug that balances things. We assume that when a company buys a company for more than it's worth, or at least the fair value of its net assets, there must be some kind of reason for it. It must be like an intangible reason. Maybe Amazon thinks that Whole Foods is going to help with their brand, or maybe Whole Foods is like an intangible brand that like doesn't show up in the actual assets that Whole Foods has. So basically, goodwill is just a plug, right? So goodwill just equals purchase price minus the fair value of acquired net assets. So in this case, I'm paying $10 billion for Whole Foods, or Amazon did, but they're only getting $3 billion of assets. So that means that $7 billion of goodwill is being created. So now I'm going to get into goodwill impairment. Goodwill impairment is basically the same thing as an asset write-down, but it happens after a company's completed an acquisition. It's basically, oh shoot, this acquisition's gone badly. Let me impair my goodwill because clearly this was a bad acquisition. It's also non-cash, so it works the exact same way as an asset write-down. I'm just going to go right here and basically just copy and paste it. So basically what happens is, let's say, I'm just going to copy and paste and just plug in the numbers. So basically, instead of an asset write-down, it's also after operating income. It's called goodwill impairment. And let's say it's $50. So pre-tax income down 50, net income's down 30, and then you add it back in cash flow from operations as well because it's non-cash. And then instead of PP&E being down, goodwill is a separate long-term line item on the balance sheet, as I established earlier. So same thing here, shareholders' equity be down, but the balance sheet balances. All right, 3 left, y'all. So gains and losses. This is when a company sells an asset for more or less than the book value on the balance sheet. And this is also creating a balance sheet imbalance, because if I have an asset worth $100 on my balance sheet, but I sell it for $200, I'm getting $200 in cash for something that was only worth $100. So it's creating a misbalance, right? So the gain would be the price sold for minus the book value, where the loss would be the book value minus the price sold for. So I just had some numbers in there, price sold for. So for tax purposes, as you've probably heard, if a company sells something for more than they bought it for, or a loss, there's tax implications here. If you have a gain, you have to pay taxes on it. If you have a loss, that's a tax benefit, and that shows up on the income statement. However, this is not actually related to the operations of a business, right? This is not related to the core operations of a business if you have a gain or loss. It's more so related to investing. So what happens is gains and losses are subtracted and added back to the cash flow from operations section, because even though they're happening and affecting net income, they're not related to the operations. So they need to be reclassified from CFO into CFI because they're not related to operations. So for instance, let's say I sell a $150 factory for $100. In this case, we have a $50 loss. So we have operating income, and then after operating income is losses. So 50, so pre-tax income down 50. So net income, 40% tax rate is down 30. In CFO, we're reclassifying it. So we're going to have 30 plus, or we're going to have negative 30 plus 50 in loss, because we're adding it back. And then in CFI, we just show whatever we sold the asset for, because you'll see in CFI, one of the line items is proceeds from sale of long-term assets. So here we just have proceeds of whatever we sold it for, which would be 100. So in total, we have CFO of 20 and proceeds from the sale of long-term assets of 100, which makes sense. Here is basically just tax implications, right? We have a $20 tax benefit from this loss, 50 times 20, 40%. And then we also have what we're actually getting in cash. So we have $120 that change in cash. So assets are 120 in cash minus 150 in PP&E, because we sold it when we sold an asset that was worth 150 on our books at the beginning of the year. And this equals shareholders' equity, which is down 30 from our net income. A gain basically operates the same way. Let's say we sold it for $200 instead. So here we have a gain of 50. So this increases our pre-tax income. So pre-tax income is up 50. So then our net income is up 30. Same thing here, except we actually subtract the gain, which is a bit counterintuitive, right? You subtract the gain because we're reclassifying it to cash flow from investing. So even though the gain is like a cash thing, we're benefiting from it, it's not appropriate to put it in CFO because it's not related to our operations. So CFO is actually down 20, right? Down 20. That's just the tax implications of the gain. Taxes are operating. And then the proceeds here would be 150, whatever we sold it for. Here, actually, I guess it'd be 200. We're selling it for 200. So The proceeds are 200. So here again, tax implication, CFO, what we're actually getting here in CFI. So I would just always use the term reclassify from CFO into CFI, or cash flow from investing. And then now you have 180 in cash. PP&E is still down 150, and then shareholders' equity is actually up 30. So this is how it balances here. So that's gains and losses. Just always remember the reclassifying part of it. PIK interest now. I'll erase this. PIK interest stands for paid in kind. So even though you aren't paying interest in cash, it shows up as an expense on your income statement. So PIK interest is basically non-cash interest. So basically what happens is when you incur PIK interest, what happens is instead of paying the interest in cash right now, the interest gets added to the total principal amount you owe for the loan. So let's say I give you $100, but you can't pay me an interest this year. I basically say, okay, man, that's kind of annoying that you can't pay me my interest. So now you're going to actually have to add that to the principal. So now you owe me $110, which is bad for you because you actually have to pay 11 in interest now if you pay 10% interest expense. So the benefit to PIK interest is you don't have to pay cash now. But the bad thing is you have to pay more in interest later because you have more principal amount. So that times the interest rate will lead to higher interest expense. So let's say you take on debt of $100 with 10% PIK interest, you're still incurring that interest expense. So you're going to have negative 10 in interest expense. So PTI, sorry, you're 10 in interest expense. So pre-tax income is down 10. So net income is down 6. And then what happens is in CFO, your net income down 6 plus PIK interest because it's non-cash. PIK plus PIK interest is non-cash. So basically, PIK interest non-cash. So you add it back. So CFO actually is up 4. And then on the balance sheet, well, first of all, in CFF, cash from financing, you don't show that your debt is going up because even though your debt is going up from this, you're not actually getting cash proceeds. So it doesn't show up in cash flow from financing as debt issuance because you're not getting any money from it. The benefit is you're not having to pay the interest, which already shows up here. So you'd be double counting if you did a cash inflow from debt issuance. So then on the balance sheet, you have your assets are up 4. Your liabilities are up 10 because your long-term debt is up because the PIK interest got added to the debt. And then your shareholders' equity is down 6. So 10 minus 6 equals 4, so it balances. But it really gets interesting in year 2 because what happens then, right? Let's say in year 2, I pay off all the debt at the end of the year. Because it's the end of the year, this is an important thing. An important thing to pay attention to when getting questions is, okay, it was the end of the year. That means that I'm still going to incur the interest expense. If I paid it off at the beginning of the year, I wouldn't be paying interest expense. But if it's the end of the year, I do incur the interest expense. So I had $100 of debt, but the $10 from last year got added. So now I have $110 of debt, 10% PIK interest. That means I have now negative 11 in interest expense. So, sorry, 11 in interest expense. So negative 11 in pre-tax income. 40% of 11, just always do 4 times 11, so 44. So that's going to be 4.4. In a tax benefit. So it's 11 minus 4.4. That's going to be 6.6. So negative 6.6 in net income. And then CFO, it's negative 6.6 in net income plus PIK interest, right? Still non-cash plus PIK interest of 11. So CFO equals 4.4. And then in CFF, we're paying down the debt. And how much do I have to pay down? If it was the beginning of the year, I'd be paying down $110. That was my debt. But because it's the end of the year and the interest has gone to the principal, now I have to pay down 121 at the end of the year, 110 plus the $11. So minus, this is a cash outflow. So on the balance sheet now, my cash is, what is it? It'd be down 116.6. And then I would have debt. Sorry, it's 100. No, it's 116.6. Is my debt? What is my debt down? You might think, oh, my debt's down 121. Well, we're just looking at the net change in debt from beginning of the year to the end of the year. At the beginning of the year, the debt was 110. Then it went to 121 mid-year, and now it's at 0 because I'm paying it off. So just from the beginning at 110 to 0, which is now, my debt actually only went down 110. Of course, it was at 121 at one point, but at the beginning of the year, it was 110. So debt is down 110. And then net income is down 6.6. So it balances. The retained earnings flows, net income flows into retained earnings, flows into shareholders' equity. So it balances at down 116.6. So that's the last thing I covered in my lecture. There's a couple other things: stock-based comp, DTAs, and then a few like dividends and buybacks and leases that I'll cover next time. But that was it for this lecture. So thanks for coming, and hopefully I'll see y'all in person at the next one. Bye, y'all.